And it has, of course, been another really busy year. But it's also been a busy year for markets, so I'm going to look at some of the key talking points. And first up, inflation. Now, inflation's been on a bit of a roller coaster ride over the last few years. We had the up, where the consumer prices index reached a 40-year high of 11.1%, and now we've had the down. We started the year at 4%. Since then, it's actually fallen below that historic 2% target rate set by the Bank of England, before just creeping up in the last update due to the energy price cap being lifted. But it looks as though inflation is pretty much back under control. And this is also being reflected in markets. This chart shows the average daily movement of the UK stock market on those days when inflation data is published, and this is a movement either up or down, so that's in orange, versus all other days in yellow. And we saw that on those days when inflation data came out, the market was a lot more volatile. If we change this to this year, we can see that the effect is much smaller. Markets are still slightly more volatile on those days when inflation data comes out, but certainly not by as much. Does this mean that we can finally stop worrying about inflation? Well, earlier this year, Ipsos, the polling company, surveyed 30,000 people from 29 different countries around the world and asked them to name what are the biggest problems affecting the world at the moment. They had to choose from this list here. They had to choose 3 things from it, and the most popular choice was inflation. People are still worried about inflation, more so than climate change or terrorism. At the bottom there, we've got COVID. There are still 4% of people worried about that. But that has, of course, come a long way down. If you look at this chart, which shows the time series of some of the bigger worries up there, that red line, that is COVID. So obviously that was at the top a few years ago, and that's come right down. And the purple line, that is inflation. So that saw an increase a couple of years ago. But that too is now starting to come down as well. COVID may not have been a big talking point this year, but something which has gripped the world is election fever. So 2024 has been described as the biggest election year of all time. So what effect have these elections had on markets this year? Well, we're going to look at all 70. We'll just look at 2 of the bigger ones, starting, of course, with the UK election. In case you missed it, this was the result. A convincing, resounding win for the Labour Party, one of the biggest wins in UK election history. So what effect did this have on the market? Well, the UK stock market is closed between 4:30 p.m. and 8 a.m. But thanks to the FTSE 100 futures market, which is open nearly 24 hours a day, we can see exactly how investors reacted when this result came in. So this is the FTSE 100 futures market on the day of the election and the day of the results. And the exit poll came in at 10 o'clock right there. And markets more or less stayed flat. And they stayed pretty flat throughout the early hours as the official results came in. And then suddenly they dropped at 2:30 p.m., which is when the US market opens. So we've just had the biggest election result in UK history, and the UK market's more interested in what the US is doing. And this is because the result did not come as a surprise at all. It was heavily forecast. So it was effectively already priced in, and therefore markets did not move much at all when the result actually came in. So what about the US election? The final result was actually quite one-sided. Not only did Trump win all of the key swing states, but the Republicans actually got a higher percentage of the votes than they did last time in all 50 US states. What did this do to the US market? Well, let's just go back to the last time he won, back in 2016. And on the day of the results, the US market, the S&P 500, was up more than 1%. By the end of the month, it had risen more than 3%. Fast forward 8 years, and Trump wins again. This time, the US market goes up 2.5% on the day, and is up by more than 4% by the end of the month. So US market really seems to like Trump. Overseas markets, not so much though. So on the day of the results, although the S&P 500 index was up 2.5%, the global stock market, excluding the US, was actually down about 1%. And this is due to worries such as what tariffs could Trump be about to impose on overseas trade. So the US market seems to like him, for now at least. Overseas markets, not so sure. So next up, we're going to talk about the 5th of August. Can anyone remember what happened on the 5th of August? Well, it just so happens that for the last couple of years, it seems, there's one day in particular where markets decide to have a bit of a nightmare. In 2022, it was in February when Russia invaded Ukraine. In 2023, it happened on when Silicon Valley Bank collapsed. This year, it happened on the 5th of August for a couple of reasons. But I thought I'd give you a bit of an insight into what happens, what we're thinking, and what we do when we come into the office one day and markets are throwing a bit of a tantrum. Now, 5th of August was a Monday, and on Thursday the 1st and Friday the 2nd of August, markets are already starting to wobble. This is partly due to a weak US jobs report, which showed that employment growth was a lot slower than expected, leading to fears that the US could be about to enter into a recession, and that the Federal Reserve had simply left it too late to start bringing interest rates down. Meanwhile, in Japan, and that red line there is the Nikkei index, which measures the Japan stock markets, the Bank of Japan had just hiked interest rates to their highest level in 15 years, causing the yen to surge, but Japanese stocks to tumble. But the Japan figure aside, there's nothing particularly extraordinary about these returns, so you don't really think about them too much going into the weekend. Now, along comes Monday the 5th of August, and as usual, I get to Reading Station, get on the Elizabeth line train, which is actually running on time for once, so I'm actually in a slightly better mood than usual. Then, as usual, I get out my phone as soon as I get on the train to play Wordle. But there's a news notification on my phone, which says, Japan's Nikkei index falls 12.4% in its biggest one-day drop since Black Monday in 1987. And suddenly, instead of trying to think of 5-letter words, I'm thinking of a load of 4-letter words. And the reason for this drop was the same reasons that markets were down before the weekend. It's just now investors are really starting to panic. So I eventually get to the office, dreading turning on the Bloomberg terminal, and unsurprisingly, it's a sea of red. Everything is down. Thankfully, not everything is down as much as Japan is. Most equity markets are down around 2 to 3%. When you add that onto the damage that was done before the weekend, this is starting to turn into quite a severe market downturn. So what do we do? Well, the first thing we do is don't panic. We've seen enough downturns to know that what you don't want to be doing now is lots of knee-jerk reactions and panic selling. Instead, our first priority is to get some communication out. So by 10 a.m., we've sent out an email to the advisors, power planners, and technical support, explaining what's going on in markets and assuring them that we're monitoring them and keeping on top of it. Then it just so happens that I'm due to do my monthly market commentary with Leo, so that gives me a chance to explain a bit about what's going on to you guys. And of course, because the Japan market has been most heavily hit, we're obviously quite anxious to see how our Japan exposure is doing. These are all the Japan stocks that we held across the funds at the time. And considering the Japan index as a whole was down over 12%, some of these stocks were actually quite defensive. So KDDI and Nippon Telegraph, they are both telecoms firms. And telecom stocks are typically very defensive. They're actually two of the least volatile stocks we hold across all of the funds. And Takara Holdings, that produces and sells alcoholic beverages in Japan. So I wouldn't be at all surprised if it actually saw quite a big boost in sales on this particular day. But ultimately, on the day and in the days that followed, we don't make any significant changes to the portfolios. And that's not surprising, because most of the investments in the funds are meant to be held for the medium to long term, and should therefore be able to withstand short-term bouts of volatility. And this one really was short-term. The next day, the Nikkei bounced back 10%, and in fact, by the end of the month, most equity markets were actually in positive territory. It was like it never happened, and this is just because investor panic subsided. So it just goes to show that these sharp market downturns, as unpleasant as they may seem at the time, do eventually recover, some more quickly than others. Thankfully, this was one of the quick ones. Okay, it's time for a quick update on the Magnificent Seven. If you were here last year, you'll remember that the stock market was dominated by 7 US tech stocks amidst the rise of AI. And these 7 stocks have become so prevalent over the last couple of years that they've become easier to recite than the alphabet, which is also the name of one of the 7 stocks, Alphabet, aka Google. So this is how they did last year, and you can see they had an exceptional year, led by Nvidia, up by more than 200%, but between them, they averaged a return of 111%. So how have they done this year? Well, they've continued to do well, not quite as exceptional as last year, and again, Nvidia's leading the way, but this time they've averaged about 50% between them. So they're continuing to ride this wave. But it's not been smooth sailing. These stocks are actually quite volatile. This is their standard deviation of returns. So this is a measure of how much variation there is in their day-to-day movement. And you can see that the Magnificent Seven, almost twice as volatile as the S&P 500, and even more so than the FTSE 100. So they've done exceptionally well, but it's not been smooth sailing. And because they've appreciated so much, it's actually caused some quite severe distortions in the US market, which Jake's going to look at in just a moment. So the Magnificent Seven have done well this year, but how have markets done in general? Well, once again, just like last year, the US is leading the way, up nearly 34% this year. But unlike last year, other equity markets have also done well. So emerging markets, FTSE 100, European stocks, they've all had a really good year as well. Other asset classes, gilts and real estate have done okay this year, thanks to interest rates starting to come down. Foreign currencies have depreciated slightly against the pound, and the only significant drag this year has been infrastructure funds. And this is due to a number of reasons, largely surrounding uncertainty over where inflation and interest rates are going. So the moment of truth, how have the funds done this year? How have your portfolios done this year? And I'm pleased to say that the Cautious Risk Fund has returned more than 10% in the last 12 months, Balanced Fund over 13%, and the Growth Fund and all of the equity funds in excess of 17%. So we are really, really pleased with how the funds have done this year. Having had a really good year, it's nice to present those nice returns. So I look forward to speaking to some of you later on, and otherwise have an amazing Christmas. Thank you.